Welcome to this Killik Explains finance video. This week, a massive topic distilled into a short video. I'm calling it factor investing. That doesn't sound too tempting. It's simple access to some pretty smart ideas. How does it work? What are the pros and cons? So, let's imagine we could bottle Warren Buffett, one of the world's most successful investors, take his magic formula, put it in a bottle and reproduce it through one simple fund purchase. Amazing. Or imagine we could take an active portfolio manager's expertise and capture it for the price of a passive fund. Is it possible? Well, factor investing fans would say, yes, it is. Now, it goes by a number of names. The marketeers love this area. It's relatively new. It's developing fast. So you will hear people talk about smart beta. You'll talk about style investing. You'll hear about them use the phrase alternative beta. They all stack up to roughly the same thing. This is a quest to tap into the fundamental factors that drive risk and return for equity investors. Bottle, if you like, expertise, core factors into one product. Now, what does that actually mean? So what are you buying as a factor investor? Well, the bare bones of it are you put your money into some sort of smart beta or factor investing fund, and it trogs off following probably a computer program and invests in a factor index. So an index built on some of these factors. Probably not all of them, and they do vary from fund to fund. So watch out for my word of warning at the end. Now, what are these factors? Well, MSCI, one of the biggest index providers, identified 6. You will hear opinion divide on this. But the common ground is these are things that drive the risk-return relationship in financial markets and give you the chance to find pockets of outperformance potentially. So one of them is value or cheapness. Now, whole PhDs have been written on this topic, so I'm really summarizing an awful lot here. So cheapness is one factor. Cheap stocks have tended, if you look back, to outperform more expensive ones. Momentum, strong momentum, and I'll explain that in a moment as to why that anomaly might offer a chance to make outsized returns. Higher quality. High quality stocks have tended, if you're Warren Buffett, to do better than low quality stocks. This is balance sheet and financial strength, if you like. Yield, that's the opposite, if you like, of this one. So higher yields and lower values often go together. Another way of cutting the same cake, you might argue. Volatility, the low volatility anomaly. Why is it that actually low volatility stocks sometimes outperform higher volatility riskier stocks? And you've got size. There is some science, there are papers that say that the smaller performance of companies over time beats that of larger companies, and there's a reason, which I'll hint at in a moment. So you've got 6 factors in total if you follow MSCI's framework, and a paper written in 2012 suggests that Warren Buffett's outperformance could be distilled down to 3 in particular: value, quality, and volatility. Throw some leverage in, some gearing or some debt, and actually were you to strip out from Berkshire Hathaway's portfolio the stocks that were following just those 3 main factors, you could even outperform his incredible outperformance using, if you like, his own game. Now, how does it work? Essentially, why are you being rewarded for these factors? I'll just pick on 3. Smaller firms are generally less liquid, less heavily analysed. So perhaps there's something in that that says investors should be rewarded for investing in smaller firms. And historically, they often have been. Value stocks are cyclical and require patience. Not all investors are patient, so maybe there is actually additional reward to be had for taking that kind of risk. And if we looked at the momentum factor, some people would say, well, momentum lasts a lot longer than it should because institutional investors all herd together. You don't necessarily have to join them, and there is money to be made in understanding how that momentum principle works. So you can see that each factor has a lot of science and an explanation behind it as to why it works. And a fund may look at just 3 factors, may look at all 6, may even look at some different ones that I haven't mentioned there. Now, what can go wrong? Surely this is too good to be true. Warren Buffett in a bottle. Well, basically, there are a couple of things that can go wrong, and there are some more. Here are 2 big ones. BlackRock have projected that this market could go from 280 billion now to 2.4 trillion by 2025. And as more and more people get on the bandwagon, the danger is that the advantage of factor investing starts to evaporate. Secondly, the market can remain irrational longer than you can remain solvent, said Keynes, and there's an argument for saying, actually, this is not a way to make money quickly. You've got to have patience if you're following some of these factors. You've got to be able to see out entire business cycles potentially to make money. So, 3 tips. If you're thinking about getting into this part of the market, 3 tips. Number 1, know what's under the bonnet. Know which factors you're following. Do you understand them? Do they make sense in combination? And where are we in the cycle in terms of when you're likely to get a return? Secondly, choose carefully. There are lots and lots of funds coming in with similar products, following similar factors. They all charge different amounts of money for it. So screening is becoming increasingly important in this part of the market. And finally, be patient. This is not get rich quick investing. All right, and that will put some investors off, which is probably why some of those factors exist in the first place. So there you have it. I've reduced a vast topic to a very short video. Any questions to the usual place. And if funds is a topic you want to find out more about, please go to killikexplains.com and click on the Funds tab.